Good morning, everyone. This is Carrie Valerie R. Palmares, and together let us solve the problems for the topic differential analysis and product pricing. It's time to apply what we learned in the previous discussions. So we will be solving the short problems listed in the left side. Let's go! So the first problem is EX9-2, which is a differential analysis for a lease or buy decision. Car Corporation is considering new equipment. The equipment can be purchased from an overseas supplier for $3,900. The freight and installation costs for the equipment are $515. If purchased, annual repairs and maintenance are estimated to be $410 per year over the 4-year useful life of the equipment. Alternatively, CAR can lease the equipment from a domestic supplier for $1,750 per year for 4 years with no additional cost. So, our task is to prepare a differential analysis dated August 4 to determine whether CAR should lease or purchase the equipment. So, take note that this is a lease or buy decision, so the perspective should be on the equipment user, so as opposed to the equipment owner. Let's answer EX9-2 for Car Corporation. So we have two alternatives. Under alternative 1 is to lease the equipment, or under alternative 2 to purchase the equipment. And we will examine the differential effect on income if we were to choose alternative 2. So let's start. If we will purchase the equipment, we will have a purchase cost of $3,900, which is a negative effect. Freight and installation cost of $515, another negative effect because these are all costs. And then we have repair costs of $1,640 computed by multiplying $410 as the annual repair times 4 years. However, if we will lease the equipment, we will have a leasing cost of $7,000 computed by multiplying $1,750 as the annual leasing cost times 4 years. So if we total the loss under each alternative, we will have a loss of $7,000 under alternative 1, which is to lease the equipment, and $6,055 loss under alternative 2, which is to purchase the equipment. So we have a differential effect on income of $945 favorable effect if we were to choose alternative 2. So our decision is that Car Corporation should purchase the new equipment. So the next problem is EX9-4, which is a differential analysis for a discontinued product. The condensed product line income statement for Dish and Dat Company for the month of March is as follows. So as you can see, this is the product line income statement. For the Bowls product line, we have an income from operations of $11,000. And then for Plates product line, we have $20,600 income from operations. And lastly, Cups product line, which has a loss from operation of $2,200. Fixed costs are 15% of the cost of goods sold and 40% of the selling and administrative expenses. Dish and Dat assumes that fixed costs would not be materially affected if the cups line were discontinued. So we are tasked to prepare a differential analysis dated March 31, 2016 to determine if cups should be continued or not. And another requirement or question is that should the cups line be retained? So we have to explain that. Let's answer EX9-4. So there are two alternatives, whether to continue the cups product line under alternative 1 or discontinue the cups product line under alternative 2. So if we will continue the cups product line, we will have in the same situation. So we will still have a loss of $2,200. However, the catch is what will happen if we will discontinue the cups product line. So for alternative 2, the only relevant costs are the variable costs, since we will not incur any variable cost if we will to discontinue the cups product line. However, for fixed costs, since they are fixed costs, so we will still incur the fixed product cost of $2,520 and the fixed selling and administrative expenses of $6,680. So this would be the differential effect on the income if we were to choose alternative 2. So as you can see, under alternative 1, we will incur a loss of $2,200. However, if we will discontinue the cups product line under alternative 2, we will incur a higher loss of $9,200. So if we were to choose alternative 2, we will have a negative effect on income. Thus, the decision should be Dish and Dat must retain the cups product line. So let's proceed to the third problem, which is EX9-7 make or buy decision. Jupiter Computer Company has been purchasing carrying cases for its portable computers at a purchase price of $70 per unit. The company, which is currently operating below full capacity, charges factory overhead to production at the rate of 40% of direct labor costs. The fully absorbed unit costs to produce comparable carrying cases are expected to be as follows. So direct materials per unit is $45, direct labor per unit is $20, and then factory overhead, which is 40% of direct labor, is $8, with a total cost per unit of $73. If Jupiter Computer Company manufactures the carrying cases, fixed factory overhead costs will not increase and variable factory overhead costs associated with the cases are expected to be 15% of the direct labor cost. So, our task is to prepare again a differential analysis dated July 19 to determine whether the company should make or buy the carrying case. And another requirement is, on the basis of the data presented, would it be advisable to make the carrying cases or to continue buying them? And we will explain that. Are we all set? Let's answer EX9-7 of Jupiter Computer Company. So there are two alternatives. Under alternative 1 is to make the carrying cases, and under alternative 2 is to purchase the carrying cases. Let's examine first alternative 1. If we were to make the carrying cases, we will incur the following costs. For direct materials, we have $45. This is given in the problem. Direct labor, $20, also given in the problem. Variable factory overhead of $3 computed by multiplying 15% to $20 direct labor. And lastly, fixed factory overhead, which is $5, computed by deducting the $3 variable factory overhead from the $8 total factory overhead. So under alternative 1, if we were to make the carrying cases, we will incur a total loss of $73. How about if we will buy or purchase the carrying cases? So we will incur the following costs. Of course, the purchase price, which is $70. And then we will still incur the fixed factory overhead of $5 because it was stated in the problem that fixed factory overhead will still be incurred or it will not increase. So under alternative 2, the total loss if we were to buy the carrying cases, that is $75. The differential effect on income, if we were to choose alternative 2, is a $2 unfavorable effect. So that would mean that Jupiter Company should make the carrying cases for its portable computers. So now we are at our fourth problem, which is EX9-8, another make or buy decision for a service company. The Theater Arts Guild of Dallas, or TAGD, employs 5 people in its publication department. These people lay out pages for pamphlets, brochures, magazines, and other publications for the TAGD productions. The pages are delivered to an outside company for printing. The company is considering an outside publication service for the layout work. The outside service is quoting a price of $13 per layout page. The budget for the publication department for the current year is as follows. So, we have salaries, $224,000, benefits, $36,000, supplies, $21,000, office expenses, $39,000, office depreciation, $28,000, computer depreciation, $24,000, with a total budget of $372,000. The department expects to lay out 24,000 pages for the current year. The publication department office space and equipment would be used for future administrative needs if the department's function were purchased from the outside. So our requirements is to prepare a differential analysis dated February 22 to determine whether TAGD should lay out pages internally or should they purchase layout services from the outside. And another question is, on the basis of your analysis, in Part A, should the page layout work be purchased from an outside company? And lastly, what additional considerations might factor into the decision making? Let's start answering EX9-8 for TAGD company. So there are two alternatives. The first alternative is to lay out pages internally versus the second alternative to buy layout services. So if we were to choose alternative 1, or to make the pages internally, we will incur the same cost: salaries of $224,000, benefits $36,000, supplies $21,000, office expenses $39,000, office depreciation $28,000, computer depreciation of $24,000, with a total loss or cost of $372,000. However, if we were to buy the layout services under alternative 2, we will still incur the cost of office depreciation of $28,000, computer depreciation of $24,000, and the cost of outside services computed by multiplying 24,000 pages times $13, the price per layout page. So, the differential effect on income, if we were to choose alternative 2, we will have a overall favorable effect if we will choose alternative 2 by $8,000. So our decision is that TAGD should buy outside publication service for the layout work. So, hello, are we still alive and alert? This is our fifth short problem, which is EX9-9 machine replacement decision. A company is considering replacing an old piece of machinery which costs $600,000 and has $350,000 of accumulated depreciation to date, with a new machine that has a purchase price of $545,000. The old machine could be sold for $231. This is a relevant cost. The annual variable production costs associated with the old machine are estimated to be $61,000 per year for 8 years. The annual variable production costs for the new machine are estimated to be $19,000 per year for 8 years. So our task is to prepare a differential analysis dated September 13 to determine whether to continue or replace the old machine. And another question is, what is the sunk cost in this situation? Let's find out. Are we ready? Let's answer EX9-9. Under alternative 1 is to continue with the old machinery, and under alternative 2 to replace the old machinery. Let's start with alternative 1. If we will continue with the old machinery, we will only have the production cost of $488,000 computed by multiplying $61,000 as the annual variable production cost times 8 years. However, if we will replace the old machinery, we will have a revenue of $231,000 from selling the old machine and a purchase price of $545,000, the purchase cost of purchasing the new machine, and a lesser production cost of $152,000 computed by multiplying the annual variable production cost of $19,000 times 8 years. So, differential effect on income under alternative 2. If we will sell the old machine, we will have a favorable effect on income. If we will purchase the new machine, so we will have a negative effect on income. However, for the production cost, we will have a favorable differential effect on income by $336,000 because we have lesser production cost if we will replace the old machinery. So overall, differential effect on income if we were to choose alternative 2 is $22,000. Decision is that the old machinery should be sold and replaced with the new machinery. The sunk cost in this situation is the book value or cost minus accumulated depreciation of the old machinery amounting to $250,000. The analysis normally focuses on the cost of continuing to use the old machinery versus replacing the machinery, thus book value is irrelevant. Are we ready? So this is the second to the last problem for this presentation. EX9-11, sell or process further. Portland Lumber Company incurs a cost of $452 per 100 board feet in processing certain rough cut lumber, which it sells for $611 per 100 board feet. An alternative is to produce a finished cut at a total processing cost of $559 per 100 board feet, which can be sold for $748 per HBF. So, prepare a differential analysis dated June 14 on whether to sell rough cut lumber or process further into a finished cut lumber. Okay, before we start answering EX9-11, can you just stretch your arms and then your legs so that we will have a fresh start in answering this problem. Okay, let's start. We have two alternatives for this. Either to sell the rough cut lumber under alternative 1 or to process further into a finished cut lumber under alternative 2. This problem is very simple. We will just input the data. So for alternative 1, if we were to sell the rough cut lumber, we will have a revenue of $611 and then cost of $452 with a net income of $159. However, if we will process further under alternative 2, we will have a higher revenue of $748 with a cost of $559. So net income would be $189. if we compare alternative 2 to alternative 1, we will have a favorable effect on income by $30 if we were to process further the finished cut lumber. So the decision should process further and sell into finished cut lumber. So classmates, we are at the last problem for this presentation, EX9-13, decision on accepting additional business. Homestead Jeans Company has an annual plant capacity of 65,000 units and current production is 45,000 units, so they are not operating at the maximum level. Monthly fixed costs are $54,000 and variable costs are $29,000 per unit. The present selling price is $42 per unit. On November 12 of the current year, the company received an offer from Dawkins Company for 18,000 units of the product at $32 each. So from $42 to $32. Dawkins Company will market the units in a foreign country under its own brand name. The additional business is not expected to affect the domestic selling price or quantity of sales of Homestead Jeans Company. So we are tasked to prepare a differential analysis dated November 12 on whether to reject or accept the Dawkins order. And we are tasked to briefly explain the reason why accepting this additional business will increase operating income and what is the minimum price per unit that would produce a positive contribution margin. So this is based from the previous lessons. Let's find out! Finally, let's answer EX9-13 for Homestead Jeans Company. Under Alternative 1 to reject the order and Alternative 2 to accept the order. So before anything else, let us still examine whether accepting the offer of 18,000 units, would the company still operate within plant capacity? So current production is 45,000 units and the offer is 18,000 units, so that would be a total of 63,000 units, which is still within plant capacity of 65,000 units. So let's proceed with the analysis. Under alternative 1, if we will reject the order, so we will have no additional revenue and we're also with variable costs because we will reject the order as if nothing happens. And if we were to accept the order under alternative 2, we will have additional revenue of $576,000 computed by multiplying 18,000 units times $32 and additional variable cost of $522,000 computed by multiplying 18,000 units times $29. So as a result, we will have additional income of $54,000. The decision would be to accept the special order. Under the requirement number 2, we are tasked to explain the reason why accepting this additional business will increase operating income. This is because increase of sale without adding additional fixed cost. So for requirement letter C, what is the minimum price per unit that would produce a positive contribution margin? Break-even price will be the amount of the variable cost, which is the $29. Since it is the only relevant data in this problem, thus any amount greater than $29 will result in a positive contribution margin. All else remain the same. So that ends my presentation for the discussion of differential analysis solutions to short problems. Just a friendly reminder, life is like accounting, everything must be balanced. Thank you very much everyone and keep safe.